Prior to the end of a long-term aggressive uptrend, there are the familiar sights from such scenarios with two small gap ups in October that aren't immediately filled. A wider flat top surrounds a central compact triple top. This, along with the gap ranges and older swing points, provide excellent markings for referencing future resistance and support. The descending trend lines have considerable influence in slowing down the developing recovery. Technically, the recovery can be classified as originating from a reverse head and shoulders, but as usual, this pattern is more difficult to spot. Also, the head is only a marginally lower upswing point. It is similar to the common situation where a triple top can also technically be called a head and shoulders, due to a slightly higher second downswing. The key feature here is the area around the 310 level that doubles as the neckline range. The reverse head and shoulders was also more difficult to identify and utilize, due to the smaller downswing point forming the right shoulder, and not directly contacting the 310 neckline area, with the minor downswing on May 13th. There is also lingering short-term resistance above 310 due to the bearish spike from April 25th and the failed double bottom before the gap down. The intersecting trend lines in July mark the approximate transition where a triple top fails and instead becomes the horizontal resting range of a regular bullish continuation. This is helpful guidance since the swing points in the range were relatively compact. As expected, the neckline range from the reverse head and shoulders is a highly influential support, but is eventually breached under the longer-term bearish conditions that are bolstered by two gap downs. Then it is no surprise the current gap down begins to halt at 285. It was the next logical mark of a major long-term support from being the head and pivotal upswing forming the last bullish recovery. The October to December uptrend was more of a passive rise due to low but consistent bullish volume under conditions of bearish overextension. This is why the gap downfill only briefly slowed the uptrend in early November. In addition, there was also the supporting influence of the 285 level that will be a key lower boundary if 310 is breached again. This example ends with a gap up completing a spread out triple bottom focused around the 285 area to initiate an aggressive uptrend that soon leads to these multi-year ranges being left far behind.